Check, please.
Welcome back to Everything Money. In this video, we talk about dividends and potential dividend traps. Companies will portray a wonderful dividend, and sometimes they can't simply afford it. We'll talk about if numbers get bad, if there's a recession or a stock market correction, what you can do if you're especially drawn to dividend companies. We'll talk about AT&T and specifically Geo Group. I give you Paul and Mo, and be cautious with dividends. Go ahead, Paul.
Guys, one of the major things we do on this channel and that attract people to our channel, our community, is we look at the numbers. We look at the financial statements, income statement, balance sheet, and cash flow statement. And one of the most common things we look at is when we look up a company. For example, let's look at Apple. We look up Apple, we find out they have a dividend yield of 0.6%. And if you watch any of our videos in the past, I look at dividends paid. And this is the reason why we laid it out here on our software. Because I want you to compare dividends paid to the 5-year free cash flow and the 1-year free cash flow. As you can see, Apple paid out about 20% of their last 5 years dividends on their current dividend yield. So that dividend is probably very, very safe. Anything under 50%, I would say, is reasonably safe. The lower, obviously, the percentage, the better. About a year ago, there was a company called the Geo Group, and everybody loved it. All of our users were like, Geo. I mean, we heard it all the time. Why? Because their dividend yield was insane. So let's pull up Geo Group. Geo Group was interesting. It's a real estate investment trust. I think they focus on prisons. Is that what it is?
Yes.
Yeah, private prisons.
They were paying a huge dividend. So I'm going to go to the cash flow statement and show you just how much. They're paying out $200 and some million, 200, 215, 230, 230, 230. Now, let's go to their free cash flow above. They didn't have free cash flow. 337, 250, 260. And we're going to splice in a video in which we question that dividend yield. Because I sat there and said, but there's only so much dividend you can pay, right? Well, guess what, guys? This is their dividend now over the last year. It went from 230 million, where is it? 230 down to 72 million. And they haven't paid a dividend basically in the last 2 quarters. Dividend traps are where the company's paying a big dividend because most people won't even look at the numbers, won't even look and see if they can support it, and they use it to attract investors. We have the same conversation about AT&T. AT&T can easily afford their dividend, but they continue going with it because they know it attracts investors. Since AT&T announced their drop in dividend, the stock has plummeted about 30%, 25 or 30%. People love their dividends. Even though dividends are highly tax inefficient, people love getting that check every single quarter. Listen, I like getting it too, but it's tax inefficient, and I only want it from a company that won't buy back its shares and has no other good use of the money. But dividend traps are where you buy a company that cannot afford a dividend purely because of the dividend. It's very simple. You look at the company and say, what are their obligations? What's their free cash flow? Can they actually afford to pay this dividend? And good companies will pay something reasonable out, but won't, because one of the worst things you can do is cut your dividend. People don't like that. There's lists of companies that consistently keep their dividend and increase it every single year. That's a very common thing. And if you can't afford your dividend, you're taking on debt in order to pay that dividend, or you're issuing shares, which dilutes other owners, right? Because there's only 2 ways to finance a business: equity or debt. Part of the equity is either putting shares in or taking the profit from the business, and debt, which is just taking on long-term liabilities to pay off debt, to pay out money. Okay? So that's the only 2 ways to do it. So with a dividend trap, you're getting stuck because you're buying into a company for a dividend they can't really afford. They're doing it just to prop up the stock price. And that's bad and manipulative on so many fronts. And I wouldn't want to invest in a company that did that anyhow. What are your thoughts, Mo?
Yeah, guys, the most important thing, I think, is you need to look and say at any big dividend that's paid out. It doesn't matter, even if it's a company like AT&T, you need to make sure that they can afford this dividend. You cannot get it was so blatantly obvious with Geo when we were looking at it. We're just saying, how is this possible? There are a lot of companies out there, especially when times get bad, that are going to try to attract investors by giving you a big dividend, whether they can afford it or not. And at some point, you're going to get burned. I remember when this happened, I think that Geo Group dropped 50% in a day. When they said, we're getting rid of our dividend. And obviously, it was because they couldn't afford it. That is a dividend trap. So please be careful with this. Even big companies, AT&T, Apple.
Well, but with AT&T, the interesting thing about AT&T was, I remember thinking to myself, it's a high dividend. They can afford it. But they're not going to want to keep this. They're going to sit there and say, we can still cut. And guess what? When they cut their dividend, they still said, we're still paying a well above market dividend.
Yeah.
So they still marketed it as, hey, wait a second. Yeah, our dividend's not 8% anymore, but it's 4%, which is still a really good dividend.
So, Paul, you make a great point. A dividend trap can be what you saw with Geo. It could also kind of be that in a way.
Yeah.
Make sure that the company is wanting to and able to pay that dividend going forward.
If this speaks to you and you need assistance in your investing journey, you can join everythingmoney.com, patreon.com/everythingmoney. You can join our chats. You can have the software behind Paul. You can make better investing decisions by finally having the data you need to make them, and we'll help you all along the way.
I still love the fact that AT&T cut their dividend. I think they should cut it to zero.
Best thing ever.
I think AT&T should cut the dividend to zero and pay down their debt. And there's an AT&T video that's probably already come out that we just did. Mm-hmm. Companies only have a set amount of cash. AT&T has a lot of debt. They need to get that debt under control first before they start paying out owners.
I think a lot of our viewers, they chase dividend companies.
This is what I want to say.
Yeah.
I want to say, guys, do not go and buy a company for its dividend.
Nope.
I say this, I've said it many times. This is like going to the ice cream shop and buying an ice cream sundae for the sole purpose of getting the cherry on top. That's exactly what you were doing. Just go and buy the bowl of cherries. You are going to get yourself in some serious trouble if you just go after companies and buy them for a big dividend. It's not going to work well.
Should I be especially concerned in a bearish market, Paul, that with things start falling and the free cash slows down, can they pay these? I mean, is this...
If it's a high yield, yeah. I mean, or if it's eating up a big chunk of their... Yeah. There's a dividend payout ratio. They usually go based on the earnings. I go based on the free cash flow. So as long as their dividend payout ratio is under 50%, just go calculate, okay, what has to happen to the business if the gross margin's high? It's like, obviously, a lower gross margin, it takes a bigger drop in revenue to take away from free cash flow. But a very high gross margin doesn't take as big a drop. So just always be tentative. If you want a dividend, great. I sit there and say, go learn options. That's a good way to make some extra cash along the way, to sell covered calls on your investments to generate some cash. Because you can generate 3 or 4% with a lot less volatility and risk by selling covered calls.
By the way, you guys, you don't need to just go buy the big dividend high flyers. Go and find good companies that are going to keep that dividend around for a long time and can afford to do it. You just might have to do a little bit more research. That's the only thing.
There are ETFs that do like the dividend paying companies that only focus on companies that have been paying a good solid dividend for a long period of time. Consistently.
And what about fiddling with the system, Paul, where people have questioned in our Everything Money chat the concept of, can I buy a stock right before dividend payouts? What is the time frame of
I actually don't know. I thought it was it's somewhere between 3 and 7 days before the ex-dividend date or something.
Yeah, they announced the dividend date. Everybody has a stock. I ignore that.
Yeah.
Really? You're not into
I just ignore that. I just sit there. That's not my focus isn't to play that game. My focus is to buy value plays and write covered calls on my investments.
And plus, I don't necessarily think that's probably a good game to play, because if it was a good game to play, you would have major hedge funds centered around doing that.
I'm sure they already do.
I wonder they're not very popular if they do.
Yeah. So either way, I just look at the dividend trap, and it's funny because dividends are wonderful. We get that check. We're like, oh, they can't take this money away from me. That is true. But remember, the money stays in the company. They can use it to make the balance sheet better. They can use it to grow. They can use it to make acquisitions, which also increases growth. They can buy back shares. They can pay down all the debt. There's so many ways to use the money that's a lot more tax efficient. When you get a dividend, the company's already paid its taxes on that money, and they're issuing to you more money, and you're getting taxed again on that. So it's tax inefficient. Buying back shares is a way better option if the company is reasonably priced.
Be careful out there with dividends. You know, Paul, I see other people really focus on dividends, and I guess I kind of...
Well, I used to too, Seth.
I always did. Life. It's like their whole investing strategies.
100%. I used to, because imagine if you're 65 years old and you're retired and you have a $2 million portfolio and you get 3%, it's $60,000 a year. So security, some pull. I mean, all of a sudden you're pulling $100,000 a year off retirement. That's wonderful.
I see.
Of course. I used to love dividends too. And I still do like getting dividends. It's still nice to have that cash flow, but it's also because of our strategy as a family office. You know what I mean? We sit there and we have the businesses. We don't want to live off our business income. We want to reinvest all of our business income back into the business. So I focus on dividends and options income to live our lifestyle. That's why I do it. But it's not because I think it's a better option. It's because I'm like, okay, it's nice to have that cash. I have to go sell to decide which stock to sell. So that's it. The Fed just announced that they're raising interest rates quarter point. And as interest rates go higher, we're going to need a higher dividend yield because right? You're going to sit there and say, well, I can go and put it in let's say interest rates are 5%. If I can go put it in a money market making 3 or 4%, why would I put it in stocks making 1.2%?
A lot safer in the money market, of course.
Of course.
Subscribe, final thumbs up. We will see you next video. Thanks for watching.